Have you ever wondered how Warren Buffett, one of the most successful investors in the world, built his wealth? The name Warren Buffett is synonymous with savvy investing and extraordinary wealth. This Nebraska-born business magnate rose from humble beginnings to become one of the richest men in the world, all through the power of smart, strategic investing. Buffett's unique investment strategy is one that has not just stood the test of time, but has also consistently outperformed the market. His approach, often referred to as value investing, is based on principles of patience, discipline, and a deep understanding of the business he's investing in. This strategy has turned Buffett's initial investments into billions, earning him the moniker Oracle of Omaha. His success is a testament to the power of his investment principles that anyone can apply, regardless of their financial background. So, are you curious to learn more about these principles? Let's delve deeper into the principles that guide his investment decisions. The cornerstone of Buffett's strategy is value investing. Now you might be wondering, what exactly is value investing? Well, it's a strategy that involves buying stocks that are cheaper than their intrinsic value. In other words, you're looking for bargains, for diamonds in the rough. You're not interested in what's hot or trending today. You're interested in what's going to give you a solid return in the long run, based on the company's actual tangible value. This is where the Buffett magic happens. While others might be swayed by market trends or short-term fluctuations, Buffett remains focused on the underlying value. He believes in investing in businesses for their long-term potential, not for their current popularity. It's like buying a house. You wouldn't buy a house just because it's popular right now, would you? You'd buy it because you believe it's a good investment, because you believe it's worth more than the asking price. But how do you determine a company's intrinsic value? Buffett, in his wisdom, has given us some guidance here. He suggests looking at factors like the company's earnings, its assets, and its future earning potential. And remember, you're not looking for the company that everyone else is talking about. You're looking for the company that's undervalued, that's underappreciated, that has room to grow. But let's be clear. This isn't about quick profits. This is about investing for the long haul. Buffett himself has said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. So, if you're looking for a get-rich-quick scheme, this isn't it. But if you're looking for a strategy that's proven to build wealth over time, then welcome to the world of value investing. So, the first lesson from Buffett: invest in value, not trends. Look for companies that are undervalued and have strong fundamentals. And remember, patience is key, because in the world of investing, slow and steady often wins the race. The second principle Buffett follows is investing within his circle of competence. Now, you might wonder, what exactly is this circle of competence? It's a simple yet powerful concept. It refers to the area or domain where we have profound knowledge and understanding. In the context of investing, this means sticking to businesses or industries we truly comprehend. Warren Buffett is a staunch advocate of this principle. He firmly believes that one should only invest in businesses they understand well. If you've ever studied Buffett's investment portfolio, you'll see that it's highly concentrated in sectors he's familiar with. For instance, he has significant holdings in insurance, consumer goods, and utilities. These are areas he's spent decades learning about and understanding. Does this mean you should only invest in industries you're currently working in or have experience with? Not necessarily. The beauty of the circle of competence is that it's not static. It can expand. You can grow your circle through continuous learning and gaining new experiences. This means that over time, you could potentially invest in a wider range of businesses. But the key is to make sure you understand them deeply before making any investment decisions. This principle underlines the importance of knowledge and understanding in making investment decisions. It's not about chasing the latest trends or jumping on the bandwagon of hot stocks. It's about recognizing what you know and, perhaps more importantly, acknowledging what you don't know. It's about staying within your comfort zone and not venturing into unknown territories. It's about being confident in your ability to assess the value and potential of a business, and not being swayed by market noises or popular opinion. In Buffett's words, never invest in a business you cannot understand. This principle serves as a reminder that investing is not just about numbers or charts. It's about understanding businesses at their core. It's about making informed decisions based on solid knowledge and understanding. And it's about recognizing that sometimes the best investment decision might be to not invest at all. Buffett's third principle is the margin of safety. A concept that originates from the world of engineering, the margin of safety is a principle that Warren Buffett borrowed and applied to his investment strategy with great success. In the realm of investing, it refers to the difference between a stock's intrinsic value, that is the actual worth of the company, and its current market price. To put it simply, imagine you're shopping for a pair of shoes. You know the shoes are worth $100, but you find them on sale for $50. That $50 difference is your margin of safety. It's the buffer zone that protects you from overpaying, and also gives you the potential for a higher return on your investment. In the context of investing, the margin of safety is all about buying stocks when they're undervalued, when their market price is significantly below their intrinsic value. This principle serves as a shield, reducing the risk of an investment by providing a cushion against errors in judgment or unforeseen market fluctuations. But how does one determine the intrinsic value of a stock? This is where thorough research and analysis come into play. By examining a company's financial statements, understanding its business model, and considering its competitive landscape, investors can estimate what a stock is truly worth. This is not an exact science, but rather a conservative estimate that provides a benchmark for making investment decisions. The margin of safety principle is not about predicting market trends or timing the market. It's about making sound investment decisions based on the fundamental value of a company. By adhering to this principle, investors can buy stocks at a discount, thereby increasing their potential for profit and reducing their risk of loss. Remember, the stock market is not a game of certainty, it's a game of probabilities, and the margin of safety principle is a tool that can help tilt the odds in your favor. As Buffett says, the three most important words in investing are margin of safety. The final principle that guides Buffett's investment decisions is patience and discipline. This principle may seem simple, but it's one that many investors struggle to adhere to. Buffett is well known for his ability to wait for the right opportunity and not rush his investment decisions. This patience and discipline are key to his successful investment strategy. Buffett's strategy can be likened to a game of baseball, where there are no called strikes. You can wait for the perfect pitch, the perfect opportunity, without any penalty. The market will always present opportunities, and the key is to wait for the right one. This is where Buffett's patience comes into play. He waits for the moment when a quality company is undervalued by the market, and that's when he pounces. Now, this doesn't mean that Buffett is inactive during his waiting periods. On the contrary, he spends this time studying businesses, understanding their models, and evaluating their worth. This preparation ensures that when the right opportunity does come along, he's ready to act decisively and swiftly. Discipline, the other half of this principle, is equally important. Buffett doesn't let emotions dictate his investment decisions. Market fluctuations, news headlines, or the actions of other investors don't sway him. He sticks to his investment plan and principles no matter what. This discipline allows him to avoid costly mistakes and stay focused on his long-term investment goals. But here's the thing, patience and discipline aren't just about waiting for the right investment opportunity and sticking to your plan. They're also about the ability to hold on to an investment for the long term. Buffett doesn't buy a stock intending to sell it in a few months or even a few years. He buys with the intention of holding onto that stock for as long as the company remains sound and its business model viable. Remember, Buffett's approach is not about making quick money but about building wealth over time. Patience and discipline, then, are not just virtues in life, but also critical ingredients in the recipe for long-term investment success. So, take a page out of Buffett's book. Wait for your pitch, stay disciplined, and keep your eye on the long game. So there you have it, the 4 principles of Warren Buffett's investment strategy. Let's do a quick recap. First, value investing. It's all about buying stocks for less than their intrinsic value, essentially looking for bargains in the market. Second, circle of competence. Stick to what you know and understand. Investing in fields you're not familiar with can lead to unnecessary risks. Third, margin of safety. Always ensure there's a difference between the price you're paying and the value you're getting. It's a buffer that can protect you from potential losses. And finally, patience and discipline. Investing isn't a sprint, it's a marathon. The real winners are those who can wait and keep their heads cool when the market gets hot. By understanding and applying these principles, you too can invest like Warren Buffett. Remember, investing is a journey, and these principles are your map. Navigate wisely, and you'll reach your financial goals.